Look at this chart. Every textbook says this break of structure is a buy signal. So why did price reverse and wipe out every single buyer few bars later? It's because you've been taught to look at a one-dimensional model. The market structure you learned is a lie, or at least it's only 1/3 of the truth. Let's fix this right now. My market structure analysis is based on 3 pillars: technical analysis, real-time price action reading, and supply-demand imbalances. The synergy between them is powerful. Market structure begins with trends. You have an uptrend when price forms higher highs and higher lows. You have a downtrend when it prints lower lows and lower highs. An uptrend in day trading might last for a few hours before reversing or stalling. A small series of bullish candles that surpass a previous swing high is often labeled as a break of structure on the upside, affirming the bullish scenario. On the other hand, if price consistently fails to make new highs and eventually breaks under a last critical low, you conclude that sellers have taken control. That is the essence of a structural downtrend. In an uptrend, buyers must be pushing the market beyond each prior pivot to maintain upward structure. But structure can shift quickly on intraday charts. A single wave of strong selling might test your assumptions. 2 vital concepts in advanced chart reading are break of structure and change of character. A break of structure often occurs when the market pushes through a prior swing point that was aligned with the existing trend. In a bullish scenario, if the price leaps above a prior high and closes convincingly up there, the structure is broken to the upside, strengthening the existing uptrend. You might see these breaks on a 5-minute chart multiple times in a bullish day. Each time, they confirm that buyers remain in control. A change of character is more telling because it signals a potential shift in balance from buyers to sellers or vice versa. In an uptrend, the hallmark of a change of character is a failure to form a new higher high, followed by a decisive break of a key higher low. This suggests that the once dominant buyers are losing their grip. If a price dips below a major low, it may be flipping from bullish to bearish. Markets do not always trend. Sometimes they stall or move sideways in a tight range. This is often called consolidation or a sideways market. You might see a zone where for hours price bounces between a support and a resistance, with no real net progress for either side. Consolidation can come before a breakout that resumes the prior trend or sparks a reversal. It can also happen in the middle of the day when volume drops or the market waits for a scheduled event. For day traders, reading consolidation is crucial, especially if you seek momentum moves. Price action is the raw record of trades hitting the market. Some see it as candlesticks with wicks and real bodies. Others see it in terms of tick bars or footprint candles. However you visualize it, price action is the best measuring instrument of immediate buying or selling pressure. Many advanced techniques revolve around watching how price reacts near key supply or demand zones. If the price snaps up quickly off a demand region, you know there is healthy buying interest. If it struggles to push beyond the supply zone on repeated attempts, that suggests strong sellers. Price action is about letting the chart speak, not overshadowing it with lagging indicators. Identification of advanced price patterns can refine your skill. For instance, you might see a short-term wedge forming in a broader uptrend. The wedge might break to the downside, generating a quick drop that retests a prior demand area. Another scenario is a fake breakout pattern, where price runs above a known high but then immediately closes below it. These patterns can be powerful signals for turning points. They are not guaranteed, but they do highlight areas where a surge of late buyers or sellers got trapped, often fueling the upcoming reversal. Advanced price patterns revolve around tracking expansions or impulses and how they fade into pullbacks or complex corrections. A classic example is a strong impulse wave up, followed by a three-wave correction, then another impulse wave up. If you confirm that each wave is printing new breaks of structure on lower timeframes, you stay confident in the overall direction. Another intriguing idea is to watch for pockets of liquidity above old highs or below old lows. Price might sweep these levels for liquidity, then reverse swiftly. Such patterns occur regularly intraday, especially if there are stops placed behind those pivot points. One approach is to wait for a break of structure in the direction of the trend, then trade the retest. Another approach is to watch for a potential change of character near a known supply zone. If you see that a change of character aligns with a cluster of short-term double tops, that can signal a shift. Supply and demand revolve around the idea that major imbalances cause dramatic price impulses. A supply zone typically forms where price consolidated briefly before a big drop, suggesting that large sellers are positioned there. A demand zone is the mirror image, where price consolidated prior to a rapid climb. If price later returns to that zone, you might see the same reaction from participants. In an intraday context, these zones might appear on a 15-minute chart or even a 5-minute chart if the swings were particularly strong. They are not indefinite. Over time, the orders that created the reaction can get absorbed or fully executed, meaning the zone might lose its potency. But in many cases, you will see repeated bounces or rejections at these zones, making them prime locations for structured trades. Some traders like to label the zone with the highest close or open within the consolidation. Others take the entire range of the basing candles. The specifics can vary, but the principle is consistent. Find the small sideways or subtle area where price paused before launching a big rally or decline. If a rally was abrupt, that implies strong buying committed in that base. If a drop was abrupt, that suggests intense selling. When price retests the zone, watch the raw price action for acceptance or rejection. Sometimes, the retest leads to another strong bounce in the original direction. Other times, the zone fails, which can itself be an actionable breakout move that signals the supply or demand is exhausted. Supply and demand zones blend seamlessly with the idea of break of structure and change of character. If you see a downtrend with consecutive break of structure events, and now price is approaching a known supply zone, your bias might be to fade any bullish spikes into that zone. If you suspect an uptrend is losing steam, and you see price form a change of character around a previously established supply zone, it can be a prime short opportunity. Support and resistance can be more dynamic and advanced than just drawing a line at a pivot. An advanced trader notices if support and resistance lines shift intraday, forming microchannels or pivot flips. For example, a strong supply zone can turn into support if price eventually breaks above it and finds new buyers on a retest. This shift can be observed from the magnitude and speed of the breakout. If price soared from that supply zone, there is a good chance it might function as a support on the retest, effectively flipping from supply to demand. A strong demand zone can turn into resistance if price eventually breaks below it and finds new sellers on a retest. And if price broke that supply zone, there is a good chance it might function as a resistance on the retest, flipping from demand to supply. Trend lines can be a sophisticated lens for day traders to see dynamic support or resistance, especially when combined with supply and demand. Suppose you have a rising channel, and inside that channel is an untested demand zone from a prior breakout. If price returns to the demand zone, right where the channel's trendline meets, you have a confluence of signals that might yield a strong bounce. That provides a structured approach for trade planning. If price slices through that confluence, it might be a strong sign of a break in structure, warning you that the uptrend is concluding, or that supply overcame that pocket of demand. Volume analysis will help you in certain contexts. For instance, you may watch how volume spikes at the moment price approaches a known supply zone. If that spike aligns with a major wick rejecting the zone, that suggests a wave of sell orders overcame buyers. A footprint chart helps us see what is happening inside those moves by showing the volume that trades at each price level during each candle. That way, we do not just see a candle's high or low, we also see how many orders occur on the buying side and the selling side at each tiny step of the candle. This detailed view can help you understand absorption and imbalances. Absorption is when large traders soak up orders, stopping price from moving. Imbalances happen when there is much stronger buying or selling at a particular price range, driving price in a direction. In a footprint chart, each candle is split into rows for each price level. You can see how many contracts were traded on the bid side, the sellers, and on the ask side, the buyers. This can paint a vivid picture of whether buyers or sellers are more aggressive at certain price increments. When there are large blocks of sellers at a certain price, you often see a big number on the bid column at that price. If there is strong buying, you see a larger number on the ask column. For day traders, footprint charts can be a revelation. They add a whole new layer to market structure. They can show if there is absorption at a high, meaning there is a strong group of sell orders that keep soaking up buys, so price cannot break through that same high. Or perhaps we see an imbalance of eager buyers stepping in at a certain low, pushing price upward. By looking at inside the candle, you discover that price is not just a line or a bar. It is the result of orders at each small step. If at a critical swing low, we see an extremely large cluster of buy orders that appear to stop further drops, that might warn us that the market is forming a new higher low and could push up again. Whenever price approaches a supply or demand zone, you can look at the footprint structure to see if large traders are unloading or absorbing positions. Absorption is when the market tries to move further in one direction, like going up, but meets a large opposing force, like big sell orders. Those big sell orders soak up all the buying that tries to push price higher, so price cannot really break up. Sometimes after that, we see a reversal. Imbalances are when one side is heavily stronger than the other. You might see large numbers on the buy side, the ask side, with only small numbers on the bid side at the same price level, or vice versa. This market order flow can lead to a swift move in the direction of the stronger force. You see, markets are always about balancing out how many are willing to buy and how many are willing to sell. When that balance is tilted heavily in one direction, price moves quickly. On footprints, an imbalance can show up when you see a big difference in the volume between the bid and ask at a specific price. That is a bullish imbalance because it suggests a lot more people hit the offer. They were eager to buy. If that keeps happening across multiple price levels in a single candle or a short sequence of candles, you know that buyers are strongly in control. The price often shoots up. Conversely, a big imbalance on the bid side is a heavy wave of sells that can drive price down. Now, let's connect absorption and imbalances to the overall structure. Suppose you have an uptrend. You watch the footprints near each pullback. This is where the market dips temporarily, but then tries to continue up. If every time the price dips, You see big buy imbalances on the footprint. That signals the path is likely to keep going upward. The structure remains bullish. Or suppose price tests a previous swing high. Now you see heavy absorption from sellers at that high. Price tries to break but cannot hold above that level. The footprint reveals that the market is not accepting higher prices. A normal chart might just show a candle that poked above and came back below, but the footprint confirms that big sellers were standing in the way. That can hint at a false breakout or a potential reversal if it keeps happening. Imagine you see a strong uptrend making higher highs. Suddenly, it tries to push to a new high but prints less buy imbalance than before. Actually, you notice a spike in absorption on the sell side. If the market fails to hold above that old high and quickly returns below, forming a lower swing high, you may have an early sign of a structure shift. The footprint is telling you that the imbalance from buyers is not as strong, plus sellers are absorbing attempts to break upward. That is possibly the start of a downtrend if the price pushes below a previous swing low. So let's recap. You will find that repeated strong buy imbalances lead to uptrends. Repeated strong sell imbalances lead to downtrends. And absorption near a prior top or bottom signals a potential turning point. The advantage is that you do not have to guess. You see how many trades occurred at each price. So if a level is truly being defended by big orders, it becomes obvious on the chart. The best day trading strategies unify structural and supply-demand logic with real-time price action cues. You don't want to rely on a single pattern or a single zone. Instead, try to piece together the trend context. Watch for a break of structure or a retest near a zone. Confirm on your footprint chart that buyers or sellers are stepping in, then pull the trigger. This market is trending down strongly overnight. Coming into the London session, the price forms a small consolidation and then continues down, showing multiple breaks of structure to the downside. You then identify a supply zone that sparked a strong move lower. When price retests that zone, you watch your footprints. If you see high levels of selling aggression at that zone, it might confirm the continuation short. While the approach is universal, your personal plan will depend on how frequently you like to trade. Some advanced day traders prefer waiting for quick scalp opportunities around supply-demand interactions. Others might hold positions longer, letting the entire session's trend play out, as multiple break-of structure events reaffirm that they are on the right side. During a day, the structure can shift from expansion to consolidation, from bullish to bearish, so you need to adapt. Setting up an intraday trade around market structure might go like this. First, you confirm the daily bias from a slightly higher time frame, such as a 30-minute chart, to see if there is a dominant bullish or bearish theme. You identify major supply and demand levels from that perspective. You then keenly watch for how price interacts with those zones on your shorter time frame, maybe a 5-minute one. If you see an emerging break of structure aligned with your bias, you'll look for confirmation in price action. That might be a strong bullish candle retesting and rejecting a prior pivot, or a footprint reading showing buyers overwhelming sellers. You enter with the logic being purely structural. Then if you see a sign that structure might be shifting again, like a minor change of character, you exit or adjust. From a purely technical standpoint, you can manage a trade by letting structure guide stops and targets. For example, if you go long after a bullish break of structure, you can place a stop below the higher low that preceded your entry. If the market is truly continuing its uptrend, that low should not be violated. For profit targets, you might look at the next major supply zone or the next likely area for a structural shift. Once price gets there, you reevaluate. If you see footprints and price actions still supportive of your thesis, you might trail the stop. If not, you can exit, locking in your gains. In your market structure analysis, one pitfall is to read too many signals into every micro swing. You see, intraday charts can be noisy, and you do not want to leap at the first small break of structure if it is overshadowed by the larger trend or the possibility of a false break. So please resist the urge to jump in after a massive directional candle. Instead, wait to see if that move aligns with a confirmed break of structure or a retest. Another pitfall is ignoring the bigger picture. If the market is in a dominant trend that has shown no true sign of reversal, a small change of character on a very low time frame might trick you into a premature position. Focusing too narrowly on each wave can cause constant second guessing. Instead, you want to keep a layered approach that spans multiple timeframes, aligned with major supply and demand references. Small refinements matter for day traders. One approach is to watch a 50-minute chart for structure while using the 5-minute footprint to refine entries. You might see the 15-minute chart break structure for a bullish push, then switch to the 5-minute to see if footprint volumes confirm a surge in buyer activity at the retest zone. Support and resistance can morph as price moves. A region that was tested multiple times might weaken, or it might accumulate more orders. You can watch if each subsequent retest sees smaller or bigger bounces. If bigger bounces occur, that suggests increased demand or supply stepping in. If it starts to flatten, perhaps you are on the verge of a break. Scaling in or out can be a viable technique if you regularly trade intraday. During strong trends, where you are confident of a continuation, rather than entering your full size all at once, you might start with a partial position at the initial break of structure. Then if price retests that break level, with footprints confirming a surge in your direction, you add more. You can exit part of your position at the next pivot or supply-demand zone. If the structure remains strongly with you, you hold the rest to see if a bigger move develops. Your framework should revolve around consistent steps and definitions. For instance, how exactly do you define a break of structure for your time frame? Is it a full close beyond the level or just a wick? How many candles do you wait to confirm a zone retest? You might require at least 2 consecutive closes beyond the swing high to call it a bullish break, for example. Or you might say a supply zone is only valid if price left it with a strong momentum candle. By clarifying these definitions, you reduce impulse decisions. Here are some rules. First, officially define how you recognize an uptrend or downtrend. Second, clarify break of structure triggers for bullish or bearish continuation. Also, specify the difference between potential change of character patterns and the confirmed reversals. And try to map out supply-demand zones in a consistent manner. So here is a generalized step-by-step approach to day trade setups using market structure. First is the pre-market prep. Mark overnight highs and lows. Identify any high-impact supply or demand zones left on the chart from the previous session. Then is the trend check. Check the bigger time frame, the 30-minute or 1 hour, to see if you have an established uptrend or downtrend, or if you suspect a new change of character. Then identify key levels. Evaluate potential breakout points, pivot lines, or supply-demand zones. You then monitor price action. Observe how price reacts near these zones. Look for bullish or bearish candlestick patterns, or specific microstructure like retests, small head fake moves, or partial breaks. Then you use footprint clues. In a strong bullish scenario, watch if the footprint bars confirm heavy bid volume at or above key inflection points. In a potential top scenario, look for absorption clusters on the ask side. Then execute. And if you're ready to fit this into a full A to Z trading system, that's what our academy is for. Link is in the description.